Hey everyone, thanks for being here. Considering it's one of the last talks of the conference, I appreciate you all coming here. Must be a tiring week, but it's a very controversial topic. Hopefully, this will excite some of you. Why Ethereum ETFs have actually failed to attract demand? Very controversial, but should spark some good debates and questions. My name is Louis. I'm the Senior Corporate Development Associate at Kaiko, and this is my colleague Adam.
Yeah, thanks for coming along. Yeah, thanks for coming along and appreciate your time. I work on the research team at Kaiko, so I've covered the ETF launch since inception over the last year and a half, so looking forward to sharing some insights.
So let's first start off by giving a brief overview of the crypto ETFs before explaining how their performance actually went and how they compare between the Ethereum ETFs, Bitcoin ETFs, and many more to come actually. So people usually tend to think that the US ETFs were the first to launch, but realistically, when you look at it, actually back in 2015 in Sweden, NASDAQ had already launched some ETPs on crypto. And then you even had Brazil in 2021 with actual Bitcoin and Ethereum ETFs. So it wasn't just the US, but to be honest, volumes and AUMs weren't that strong back then. And it really started off, and there was a very before and after moment when the US ETFs actually came live with Bitcoin in early 2024. And that really started a wave and a kind of a snowball effect with many ETF filings actually happening all over the world in the London Stock Exchange and in APAC, various regions. So that really set a precedent with its resounding success. And now to look a bit more at its actual success, I like to show this chart from Bloomberg. In orange, you can see BlackRock's Bitcoin ETF and how its performance was, well, out of this world, to put it mildly. It was the best ETF launch with any asset class, and this chart shows it reached in barely a year, in just under a year, a $70 billion AUM, which is a huge feat once you look at other ETFs and their past performance. On this chart, you have 4 other ETFs, which are some of the biggest ones in the world. Some will recognize, for example, the one in green, which is Vanguard's S&P 500, very classic. These ETFs managed to reach the $70 billion AUM threshold, but only after 4 or 6 years for some of them. So this really shows how Bitcoin was a resounding success from its start and how the demand was so intense. What's interesting is that even in the previous here, when you look at the ETFs, half of these are actually from BlackRock, and they're really a dominant player. And that's also seen in crypto for Bitcoin at least, where you see that BlackRock here, the dark blue line at the top, has actually been by far the dominant player. They've grasped most of the market share within the issuers for Bitcoin ETFs. And they have up to 3 to 4 times the AUM their respective issuers. So that's been a strong narrative, and that's been maintained from traditional financial capital markets. But now when we look at Ethereum ETFs, it's unfortunately a bit of a different story so far. More is yet to come. But Bitcoin ETF currently is at $130 billion in AUM. And when you look at Ethereum, it's closer to 10 billion. So not exactly the same performance. And you can even see that Ethereum has had a very, I'm going to call it a very tranquil growth, and has been very sadly constant. And relative to earlier, what's interesting is that the competitiveness in terms of the Ethereum ETFs hasn't been the same for the issuers. BlackRock actually struggled to become the dominant player at first, and it took much longer for them to grasp all that market share. And now, even though they're ahead, it's not as explicit as with the Bitcoin ETFs. They're above, but not as much. And this could also be explained by simply the persona of the investors behind those Ethereum ETFs are actually a bit different than the Bitcoin one. In traditional financial markets, people blindly trust BlackRock, and understandably so. And it's easy to invest in BlackRock ETFs. But with Ethereum, it's been a bit different. It's a different type of persona. It's a more, I'm going to call it crypto native persona. And as such, that's seen in this distribution. But now let's dive really in. And why do Ethereum ETFs actually struggle? So I highlighted 3 arguments. And the first one, which is fairly simple, is the unclear narrative. So when you look at Bitcoin, Bitcoin is very easy to understand and to sell. People, you can just say it's digital gold. So the pitch is very easy. It's a clear narrative. Now, when you look at Ethereum, it's a different story, once again. It's not as easy to sell. It's not just a simple one-sentence pitch. It's much more complex, and it requires a lot more blockchain understanding, knowledge, and capabilities. And so from an institutional investment point of view, that hasn't helped it. Now, a second argument is Bitcoin doesn't have much competition within the crypto ecosystem. Some say gold could be the competition, but when you look at digital assets, Bitcoin is in a league of its own, to be honest. And when you look at Ethereum, it's very different. Ethereum has a bunch of layer ones competing with it. Solana, for example, is grabbing a lot of liquidity from Ethereum. So there's a lot of competition outside of the Ethereum ecosystem, but also within. Within the ecosystem, you have thousands of ERC20s, a bunch of coins that rely on Ethereum. You have all the layer 2s, and so many other layers. And that's actually grabbing liquidity from Ethereum. People invest in those tokens thinking they have exposure to Ethereum, but they're actually not contributing to the actual liquidity and AUM as such of the Ethereum ETFs. And the last argument is Bitcoin is seen as a proxy, as an index of its own to represent crypto investing. When you have any traditional financial investor where they're gonna want to have exposure to crypto, they might just simply invest in a Bitcoin ETF. And Ethereum is more complex, and it just adds more risk for them, more even complicated risk. And so Bitcoin kind of steals the spotlight in that sense because it's just an index of its own for crypto, at least for now, and hopefully that will change. But there could be a solution. Some say staking and adding staking components to Ethereum ETFs could actually help its performance and help much more and improve its demand. Because staking is actually, and it provides an additional yield to all the Ethereum holders. And it's widely considered as crypto's equivalent to a risk-free rate. And so enabling it and adding it to crypto ETFs could potentially unlock those extra returns and thus easily enhance the value proposition of Ethereum-based products. So it could be a solution. But one thing to keep in mind is that Ethereum does have a rather, so far, low staking rate. It remains around 3% for the time being. And relative to other assets, it's, well, much lower. Typically Solana, which we were mentioning earlier, which is one of its biggest competitors, is around 7%. It was even around 15% a few months ago. So we're not talking about the same thing here. And even just to keep as a reference point, for example, in the US, if you want to invest in government bonds or the T-bills, I think the rate is around 4.3%, 4.5%. So once again, it's a higher rate than the Ethereum staking rate. So that's to keep in mind, but hopefully it's not all negative. Adam here will provide a bit more information on why this could not be the end of the world having a low staking rate.
Yeah, thanks, Louis, for the intro. I think I'll move over here so that we're not just standing next to each other like a school presentation. But yeah, if you can go to the next slide, I've got a little bit on some of the regulatory clarity that's come in. So obviously we had MiCA last year come through in Europe. We've seen some of that already for stablecoins. It's sort of just a rebranding of MiFID, wherever, but for digital assets. But it creates a sort of framework and precedent for the US now that there's a new administration that wants to work with crypto. Also, as Louis pointed out, there's already these staking products in other parts of the world. And a first SOL staking product went live in the US yesterday. Rex shares are doing swaps on a Solana ETP, staking ETP in Europe. So there's already seeing these things come in. But the really important stuff, I think, for the broader like getting more investors in and growing the kind of pie in the whole is coming next. If you go to the next slide, Louis. So this is a little breakdown of US regulatory clarity. Probably not the greatest audience because we're in the South of France here, but I'll get to the point and why it matters for Ethereum and to the fund flows. So last year we had the Financial Innovation and Technology Act passed through the Senate. It's stalled in Congress, but it creates a framework, and it's a bipartisan bill with the Democrats and the Republicans working together. And so these are kind of signs that we weren't getting 2-3 years ago. So then this year it's been followed up by the Clarity Act, which brings in some much needed kind of understanding of what staking is, what staking provides. And actually, after the Clarity Act was kind of first introduced, staking, the SEC changed its tone on staking entirely and said that doesn't consider it staking as a kind of sale of securities or offering securities. So also the Genius Act, which went through the House, which went through the Senate and is going to go through Congress next, provides like very similar to MiCA in that it's helping where reserves go, what the reserve standards needs to be for stable coins. And these these are all just names of acts and bills that are happening in America, so it's probably not that interesting. But I think the main thing about these is that these are the things that create a framework for the end user to know that they can transact and get involved in crypto without having to worry. So crypto, as Louis said, is just a kind of it's Bitcoin to most people out there that aren't in this room or at this conference. It's seen as Bitcoin. But if you can build these frameworks and have clear regulation, then more people can discover the other parts of crypto that we know are so beneficial in terms of on-chain lending and borrowing and other things, and see the value of assets like Ethereum. So I think these provide a really kind of crucial tailwind to any kind of increased investment and flow into these Ethereum ETFs. And as well as the new task force at the SEC, which is now meeting with crypto firms and not regulating by enforcement, but regulating through discourse and creating kind of relationships with key actors in the community and in the industry to make sure that they're not getting things wrong, or that they're not just going in kind of head first and saying, you can't do this, you can't do that. And it's really encouraging, and it's the end user who's going to benefit, and then they can see crypto as more than just Bitcoin or more than just, you know, the headlines that happen in 2022 and so on.
And that regulatory clarity we see in the ETFs, it's been a very positive output. This is a chart showing all the ETF filings in the US. And if we look at this chart just 2 years ago, I think this was completely non-existent. So it comes to show that regulatory clarity and the framework that Adam presented earlier has really boosted all these ETF filings, which is good because more investment vehicles enable more liquidity to be included in the market and more, and in the end, momentum for digital assets in general. So this is all very positive for us. Good regulation has really helped shape the industry.
Yeah, and I'm going to run through quickly. We did a report a few weeks ago on Kaiko indices on this untapped potential of the staking market and why it matters. I know I have a back and forth with a colleague who's in the audience who doesn't see the value of staking and doesn't understand, maybe doesn't understand crypto, but we'll get to that later. I think if you go to the next slide, I've got something, just everyone probably knows this, but you know, the total amount of ETH staked over time since ETH switched from proof of work to proof of stake. So I think it's like $50 billion if you convert it, around 35 million ETH or so on the Beacon chain right now. And like, just to put that in context in the next slide. So, you know, when ETH moved from proof of work to proof of stake, it became cash generating and became like a yield bearing asset, which kind of changes the narrative completely. But as Louis touched on, it's difficult for asset managers and issuers and advisors to get that like story across because it's not in there, it's not built into these ETFs. So like even we talk and we meet with issuers, we meet with these fund providers in the US, and they say Bitcoin's easy, it's digital gold, and it can exist alongside gold, and everyone gets that. But ETH is a little trickier, and the narrative can change from time to time, the pitch can change. But I think that when you bring in this kind of staking element and it has a yield bearing, has the kind of cash generating impact, then it kind of becomes easier to sell. You get a total return index where, you know, ETH's been moving sideways over the last year. There's only 10 billion in the fund, and yeah, the yield's only 2.9%, but it helps us soften the blow of the kind of mundane price action we've seen over the last 12 months. And this is like, you know, a 50 billion staked on ETH already. It's a huge opportunity, and I think it's going to open up that crypto native base. Is what we've seen with the Bitcoin ETFs is a lot of people off-ramped from crypto into these ETFs because they don't have to worry about security, they don't have to worry about their keys, and maybe they're at a point now where they want to have a tax-efficient vehicle that they can have their investments in if they've been early. And that hasn't been the same with ETH, and maybe it says something else about the ETH community and that they might not trust that structure. But I think if you bring in the staking and the native yield, then you're going to open up that opportunity to bring in more of that money into the ETF. And I mean, heading off any questions later, if it's only 3%, you know, the Treasury yield is 4.75% right now. But I mean, these things don't have to exist in silos. It's not a zero-sum game. You can hold Ethereum and get your 3%, and you can have your T-bills and your cash, as a lot of people do now, because we've got tokenized money markets on-chain. And it's not just, you know, a kind of pipe dream that we're going to have staking. We already have it. But there's also some issues to figure out about how that will work, how it's going to be tax efficient, how it works in the structure of these funds launch. There's grantor trusts, there's other things to figure out. But there's other, you know, these things exist in traditional finance. And it's not a security, but securities lending is a very similar format where you can have a proportion of the fund allocated to lend out to short sellers or market makers, and this provides a dividend to the investor. So this is something that traditional investors understand and know. they kind of can get to grips with, okay, I've got a total return index, I'm getting this quarterly return that's baked in. Then they can start learning about ETH. So as well as the regulation stuff protects the end user and makes sure that people can kind of play around and get involved in crypto without worrying they're going to lose all their money. This makes it so that the fund issuers, the custodians, the major banks, the pension funds can say, okay, this fits within our risk framework, we understand this more now, and they can actually start getting involved in these ETFs more, like we've seen with the Bitcoin ETFs. I think that's...
And that's it?
Yeah. Do we have any questions?
Regarding the narrative, what do you think about the narrative of digital oil for Ethereum? Do you think this is better than the current confusions around Ethereum? And also, I think if we look like the difference between Ethereum and Bitcoin in terms of like ETF, in terms of TVL for the ETF is like something like 50 billion, and the current amount of Ethereum stake is like also 50 billion. So if we had that extra 50 billion, like the rate is not going to be 30% anymore, it's going to be much lower. So is that an issue? Does it cause concerns for the investors? Like, do we get back to the problem that the Ethereum ETF staking doesn't actually generate returns at the end of the day?
Yeah, I think I can take those. I'll take the first one at least. I don't see it like oil. I know we like to make the kind of comparisons, and it's easier to kind of explain to people if we draw them back, and it does help. But I think I see Ethereum more as maybe like a NASDAQ composite, and all the layer 2s are the kind of constituents of that ecosystem. That's how I would view it. It's kind of like, you know, it's a tech index of what we're doing in crypto in Web3, and then, you know, the layer 2s are the constituents of that. If that makes sense, that's more how I would see it. And on the staking point, I don't think it's an immediate concern that this is 3%. I don't think it's how much is staked on chain. It will be a case of narrative and how those issuers go about then pitching this to people. But I think, you know, they've been able to do it easily with Bitcoin, and this just adds that, like, you know, regardless of where this is going, you've got exposure to the growth of this on-chain Web3. You've got 3% yield in them, like, that you're getting. You're committing to the security of the network, and you're actually involving yourself in the growth of kind of crypto. So there's a few narratives there that you can kind of use that I think will be pretty easy to entice more investors. Yeah.
And one thing to add on the staking yield, very interesting question. The day where we have $50 billion of AUM that comes to the ETFs, the ones that's currently staked, I think this will make a bunch of Ethereum holders also think about their staking positions. This might be also a time for them to actually exit their investments. So it's not because you have $50 billion of Ethereum that's going to instantly be staked through ETFs that you're going to remain with the exact same number of Ethereum that's staked, because people might potentially exit their position at this point. So this is not a fixed, of course, number. You have a few redemption, I think is around 2-3 days. And so this is, of course, a variable rate, variable number then of Ethereum that is staked. And so it's going to be a free-flowing. I think the market is also going to find its demand, and the supply and demand will hopefully cross at one point. So this is a variable. So I'm not too worried about it. And hopefully, if it ever becomes an issue, the Ethereum Foundation will tweak it so that the mechanism still makes sense and the incentives are still in place and aligned correctly.
Hi, two little questions, if I may. First, you're right that the staking rate for ETH is quite low, and the more validators are coming online, it's even getting lower. But some of the staking rewards advertised by Alt L1s are high, but their inflation rate is also high. So is this considered together in any way by investors, or is it also possible to make it part of the story? It's difficult to understand also for the investors. And the second one is, you referred, I think, to staking as risk-free rate, but it's obviously not completely risk-free. So there is always some risks associated with slashing, underperforming. And are the investors in staked ETFs willing to take this risk? And if not, who's going to take this risk?
Yeah, that's a very good question. I can take the first one. I think on the alternative assets, like, you know, we've got the filings here. I don't think we have the exact assets. But yeah, if you're like on Avalanche, you're getting 11% or something, but there's a lot of inflation. Solana's getting 7%, I think. In January, it was getting like 12% around the meme coin stuff when the inauguration happened. So I think it will be a case of smaller issuers might stay out of the Ethereum, like people who haven't, obviously there's less Ethereum ETFs. So if you're maybe an issuer with, somewhere in the 10 to 50 billion AUM over all your products, you'll probably maybe go for a Solana or an Aptos or maybe a Polkadot, and you'll go with that. We're generating more yield because it's easier. So you might not have I think BlackRocks will continue to dominate in the Ethereum, but in the smaller issuers will go in with these funds and they'll do more interesting things where you can have maybe a leverage return on that or other stuff. So that's how they'll kind of combat that. I don't see it being a problem. I think there's enough space in the ETF, like the ETF industry is growing massively, so it's not going to be an issue. And on the risk-free rate, yeah, I agree. It's not a risk-free rate. I think it's a thing. Crypto, it's kind of using crypto a bit to kind of say it, but yeah, it's not totally risk-free. And sorry, what was the rest?
Who's going to take this risk? Are the ETFs are okay to underperform, getting slashed 20%, or if not, who's going to take this?
Well, yeah, this creates. I think there's interesting questions, and it's why it's not happened straight away with ETH. Because there's some imperfect solutions out there, like Caesar and stuff, that don't kind of protect for that perfectly. So I think if you're looking at, you have to be quite dynamic in the yield and where the rate's coming from. So it's going to be the issuers working in conjunction with providers like I get node operators and people like Figment and Alluvials and other people. And then I guess there's other ways that things can be done. There might even be other products like we've got liquid staking tokens might end up doing ETFs on these, and these might be an alternative. So yeah, we'll see how that. But I think it's the issuer in the end of the day, and that's why it's taking so long.
And one thing to add, once the issuers will potentially work with the custodians, your slashing issue, the criteria, I hope at least, will probably be really respected strongly in terms of uptime, for example. It's very different from running your own node personally with your 32 staked, whereas if it's an institution with you have billions of dollars worth of staked assets, the SLA is in place and all the criteria should be maintained, and slashing, I think, should be an extreme, not coincidence, but should be an extreme rarity for at least for ETFs. And liquid staking also would potentially solve even the redemption potential problem. So there's a lot of innovation going in that space, and which should help the Ethereum ETFs with staking for sure.
I think that's it. I think we've run out of
time. Yeah, thank you very much.
But yeah, feel free to come to us for any questions.